Welcome to part 2 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. You briefly mentioned Wall Street, and we all know that stock markets love easy money, and the Fed has just signaled that easy money is going out of style. So why do the markets still seem relatively bullish, and how long can that last?
Well, it's a good question, and certainly the reaction on Wednesday, stock market went up a lot, and that was kind of a bullish signal. But I think a number of analysts have pointed out, and I agree, the first day reaction never tells the tale. I think what happened Thursday was maybe a better reflection. And I have to admit, I don't watch markets day to day. I watch trends, and I watch a lot of economic fundamentals. So, I'm on this podcast, so I don't have a ticker in front of me, but not sure where the stock market is this minute. Not that I actually care that much, because it does. I'm not a day trader. But I'm not sure the reaction is bullish, and indeed the reaction may turn out to be negative and consistent with the recessionary scenario I laid out. Bear in mind that historically stock markets discount recessions about 6 months in advance. Now, the stock market basically has gone sideways for a year. I mean, I understand it hit some new highs back in May, and had a technical correction in August, and bounced back up in October. But if you look at year over year, it's gone nowhere. Basically, it's gone sideways, and with a lot of volatility along the way. And if it starts to go down, that would be consistent with this recession forecast. Now, I spoke to Ben Bernanke about this when I was with him in Korea a few months ago, and he said that the Fed actually doesn't care. His exact words, he said the Fed doesn't care if the stock market goes down 15%. In other words, the Fed doesn't think it's their job to prop up the stock market, and if a reaction to Fed policy is a 15% decline, they don't care. Well, that's interesting. What about a 20% decline, Mr. Chairman? I mean, in other words, at what point does the Fed start to care? I'm not predicting that, and I'm not saying that that's in the cards. I think it's more likely we'll just see a slow grind down. But again, coming back to the underlying dynamics, not just throw a forecast out there without drilling down as to what's behind it. The Fed tightening cycle, which has now begun and will continue, in my view, through June and maybe longer, but at least through June, creates a stronger dollar. Stronger dollar is bad for corporate earnings, and we've seen corporate earnings go down significantly in 2015, and they should go down again in 2016, and that's because a lot of our major corporations and large cap-weighted components of the major indices get anywhere from kind of 30 to 80% of their revenues from overseas. So if you have a stronger dollar, that means those overseas revenues are worth less in dollars when you translate them back, and that means corporate earnings decline. Now, that is also something that lags. You can say, well, gee, we've had a strong dollar story has been out there for a couple of years. Hasn't that worked its way through the pipeline? And the answer is no, because corporations don't like to play, they don't like to speculate in currencies, and they hedge their overseas exposure, their overseas currency exposure. But the hedging market only lets you go out about a year. You can do some customized stuff, but so going back to 2014 or even late 2013, the dollar started to strengthen significantly. Really, it was 2014, 2015 story. The impact on earnings did not show up right away because they were hedged, but the hedges have rolled off, and the dollar continues to get stronger. And so even the new hedges are going to have their expiration dates. So this impact on corporate earnings is still coming through on a lag basis. So the combination of fundamental recessionary trends, deflationary trends, plus corporate earning declines coming from the strong dollar, you put all that together and you would expect stock markets to go down. And again, I'm not predicting a market crash. It could happen, by the way. We could have a market crash tomorrow or Monday, but that's just in the nature of how complex systems melt down. That's a reason to have gold in your portfolio, by the way, is, again, I'm not predicting a market crash, but if you ask me if it could happen today or Monday, I would say absolutely. And I saw it happen in October 1987 when the stock market went down 22% in one day. Now, if you converted 22% to today's Dow points, that would be 4,000 Dow points. If the Dow went down 400 points, that would be headline news all over the world. Imagine 4,000 points. Imagine what that would do to your portfolio. That's what happened in October 1987, and that's the reason to have, I recommend 10% gold of your investable assets, because whether gold's going up or down and it has been volatile, that's kind of your fire insurance in case the rest of the house starts to burn down. So that's just a little bit of an aside on gold. But getting back to the stock market, the history of stock markets and recessions is that stock markets lead the way down about 6 months in advance, and with the Fed tightening at the wrong time, not standing pat, not easing but tightening, that would just make that worse because of the impact on the strong dollar. So I'm not sure it is, happy days are here again for the stock market. We'll see how it plays out.
Well, let's briefly talk about gold a bit more before we hand this over to Alex and questions from our listeners, because it is an important topic to our audience here. And the dollar price of gold has been sort of slowly drifting down and is hovering around $1,060, I think, today. Given all the instabilities and risks that you've particularly talked about over these last few months, is that cause for surprise that the price has sort of hovered so relatively low? And looking forward, what would you expect of gold in the brave new world that began with Wednesday's rate hike?
Right. John, the surprising thing about gold at 1060 to me is that it's not lower. It actually, I know it's at a 6-year low, and I know it's come down 50% since August, the all-time high, 2011. So, I can read a ticker and I understand all that. But given what's happened to every other commodity, given what's happened to oil, copper, iron ore, given what's happened to currencies, when you look at the Canadian dollar, the Australian dollar, the Chinese yuan, given all the recessionary trends around the world, which we just talked about, it's a little surprising that gold's not kind of 950 or 875. This 1050, 1060 level, the gold has bounced off that 8 times in the last several years. Now, I'm not saying it's a hard, concrete floor, and I'm not saying it can't go lower. It could, but it has actually been fairly resilient at that level, and it has certainly gone down a lot less than other proxies or other commodities in comparison to the dollar. And I was very happy to hear you say the dollar price of gold. You didn't say gold went down. What you said is the dollar price of gold went down, and that is exactly the right way to think about it, in my view. Gold is a form of money. Now, I understand it's dug out of the ground. There's a mining industry, and I know a little bit about mining and how you do it physically and feasibility studies and the chemistry of it and the electronics of refining. So there's a lot to it. But at the end of the day, you're doing all that digging and mining and milling and refining to get money. So gold is a form of money. So when I think of gold versus the dollar or gold versus any other currency or gold versus Bitcoin or the dollar versus Bitcoin, take your pick, I'm just comparing two kinds of money, none of which have yield. Gold has no yield. That's well known. It's one of the standard criticisms, but I don't consider it a criticism. I consider it a tautology. Dollar has no yield, right? Because take a dollar bill out of your wallet and look at it. What's the yield? Yield is 0. And you say, oh, I can put it in the bank and get a yield. Well, yeah, you can, but it's not money anymore. I mean, the Fed calls it money. That's because they're in the business of maintaining this mystical illusion about where money comes from and what money really is. But if you put your dollar in the bank, you don't have money anymore. You have an unsecured liability of what may be, one recent past, a technically insolvent financial institution. And if you assume that you can easily get your money out, most days you can, but talk to the people in Cyprus, talk to the people in Greece, talk to the people in the United States on March 1933 when the president, by executive order, closed every bank in the country. Yeah, I went to an ATM machine yesterday. I was in New York, and I tried to get $500 out and said, no can do. Plenty of money in the account. That wasn't the issue. It said, I'll give you $300. And I sort of smiled because I've been saying for a long time that when in the next panic, the ATM machines in the United States will be reprogrammed, so they'll only give you $300 a day for gas and groceries. I think that the folks on this call have heard me say that before. I've certainly said it a number of times, and I use it as an illustration of how Greece can come to America, and $300 was the number I picked as, kind of gas and grocery money, and the government would just say, well, why do you need more than that? And I just thought it was funny that this machine in New York would only give me $300 yesterday. So maybe that was my punishment for for giving the forecast. But the point is, a dollar in the bank is not money. It's as I say, it's an unsecured liability of a financial institution that can easily shut its doors. And you can get yield. You can buy stocks. You can buy bonds. You can buy real estate. You can buy all kinds of things. But real money, such as the dollar or Bitcoin or gold, don't have a yield. They're not supposed to. And so when I think about the dollar price of gold, to me, it's not really a gold story. It's a dollar story. And it's pretty simple. In a strong dollar environment, you would expect a low dollar price of gold. In a weak dollar environment, you would expect a high dollar price of gold. So if you want to know what's happening with gold, you have to ask yourself what's happening with the dollar. And we just spent a lot of time talking about what's happening with the dollar in terms of the Federal Reserve. And so now there are other forces at work. There's this whole you call it mismatch or outtrade or whatever you want to call it between the physical gold market and the paper gold market. I think folks on the call are pretty familiar with that. There is manipulation going on. I mean, I've spoken to PhD level statisticians who have done these, more than one by the way, who have done these studies, and they say the manipulation of the gold futures market is blatant. It's amazing no one's been arrested, but if the people behind it are the Chinese, then don't expect them to get arrested. So that's out there. And the other trend that's going on, and I hear this from my friends at the Physical Gold Fund who are very plugged in, but I've spoken to other dealers, other participants in the physical market. They said the demand for physical gold is voracious, that people are lined up. So when I look at strong dollar, weak commodity prices, and then look over at gold, if that were the only thing going on, my question would be, why is gold not lower? So I think it's had very good resilience at this 1050, 1060 level. But if you ask me for an explanation of that, I would say that part of that explanation is this voracious demand for physical. I mean, while all the talking heads on TV are like, oh, gold's down, gold stinks, whatever, smart people around the world, not Americans, by the way. This is, you see this in Australia, you see it in China, you see it in parts of Europe, I see it with the Swiss, the Germans. I see it around the world. I don't really see it so much in the United States. I see it in South America, by the way. I don't see it so much in the United States. Americans have just been probably hopelessly programmed to not think of gold as having much value. But around the world, people are backing up the truck. They're like, hey, 1050, I'll take it. Buyer, just get me some gold. We're hearing about delays. It's a law in the United States that if you're a physical gold dealer and a customer comes in and says, I'd like to buy some gold, and you don't have any on hand, and you're just like, okay, I'll take the order, here's the price, and I'll get it to you in 2 weeks or whatever. If that waiting period, that shipping period, is more than 28 days, it's against the law. That's because that's the definition of a regulated futures contract. If you're a dealer and you sell gold more than 28 days forward, you have technically crossed a line into an illegal off-exchange futures, and you could be subject to enforcement action by the SEC. And in the extreme case, it could actually be a crime. So dealers are, have to deliver within 28 days. I talked to a dealer recently. He said that's not happening, that routinely it's taking more than 28 days to source the physical. Everyone's turning a blind eye. I mean, there's no reporting on this. The customer doesn't care because they want the gold. The dealer doesn't care because they want the order. Everyone's tiptoeing around the 28-day rule. But the point is that those kinds of delays are not unusual. So that there are a lot of other stories to that effect, but that gives you some sense of what's going on in the physical space. So you've got price suppression, price manipulation via the futures market. You've got voracious high-end demand from Russia and China, which is not abating. You've got voracious retail demand from everyday people around the world, although not apparently in the United States, buying up the gold. So there's this giant tug of war going on where the deflationary, recessionary forces want to take it down. The technicals and the demand for physical want to prop it up. It's in an unstable equilibrium around, right around the 1050, 1060 mark. So where's it going to go? Well, in the short run, just because something's unstable in the long run doesn't mean it can't persist in the short run. In the short run, I would expect everything I just described to persist for a while, because the deflationary interest rate hike, weak economy forces are still trying to move it down, but the physical demand, strategic buying by Russia and China are still going on. So those opposing forces are kind of still in play. At what point does the market look around and say, you know what, this strong dollar is killing us. It's killing the U.S. economy. It's a political liability. The Fed has blundered, raised rates, wrong direction at the wrong time. We've got to get some inflation going on, and that's going to be good for the dollar price of gold. When does that happen? A very interesting thing happened on Wednesday, and this is no coincidence. On the same day that the Fed raised rates, the Congress blew a hole in the budget caps. Led by Paul Ryan and with cooperation from Nancy Pelosi and Senate leadership and the White House, they went on a spending spree. And they blew through these caps that they enacted a couple years ago. Because remember all the talk about the fiscal cliff and shutting down the government and no more spending and we got to get this under control. That we all kind of lived through in 2012, 2013, 2014. I went away because they enacted these hard caps, and the caps have guided the budget for the last couple of years. Well, guess what? The caps have been blown up. This is like a crime spree, a smash and grab by Republicans and Democrats. They're in it together. So what did the Democrats get? Well, they got social spending, they got big solar tax credits, climate change. That's the stuff they like. What did the Republicans get? They got pork, they got more defense spending. So they were all in it together. But the significance to that, think of it as kind of hard to picture Janet Yellen in a tracksuit, but picture Janet Yellen in a tracksuit as part of a 1 mile relay where each runner has to run, a half mile, and they pass the baton. Well, Janet Yellen just passed the baton to Paul Ryan. On the same day that they raised rates, Yellen in effect was saying, we're done. We 0 rates, 6 years, enough's enough. We've done all we can. Don't ask us to do more. We're not even sure it's working. We got to get back to business here at the Fed. We're raising rates. Over to you, Paul. She hands the baton to Paul Ryan. He blows a hole through the budget ceiling and starts spending money. Well, what is that? That's helicopter money. That's what helicopter money is. And a lot of people don't understand the difference between QE and helicopter money, but it's very simple to explain. QE, or quantitative easing, is money printing. But the way it works mechanically is the Fed prints the money, they give it to the banks. The banks give it back to the Fed in the form of excess reserves, and the money doesn't go anywhere. The banks don't lend it. People don't want to borrow it. Nobody spends it. It has no what's technically called velocity. It doesn't do anything for the economy. It's a very sterile exercise. It has some marginal impact maybe on long-term asset prices, but the money just goes in a circle. The Fed prints it, gives it to the banks deposit with the Fed as excess reserves. End of story. Helicopter money is different. Now we've all heard the notional, the metaphor, and Ben Bernanke talked about this in a very famous speech, and I believe it was 2004. It might have been no, I'm pretty sure it was 2004, referring to something that Milton Friedman had said long before that, which is, the Fed can always cause inflation. The Fed can always cause inflation. All we have to do is print money, rent some helicopters, push out the helicopters, people run around, pick it up and spend it, boom, there's your inflation. Well, that was the metaphor, but how does it actually work? How do you actually do helicopter money? Well, helicopter money requires cooperation between the fiscal authority and the monetary authority. The monetary authority is the Federal Reserve, the fiscal authority is the Congress and the White House. What you do is you run bigger deficits. You spend money, basically. You spend money you don't have. You run bigger deficits. The Treasury borrows the difference to cover the deficits, and the Fed buys the Treasury bonds. So it's basically debt monetization, pure and simple. And we haven't had that since 2009. I mean, we have in a way because we continue to run deficits, but in terms of combining Fed debt monetization with bigger deficits, we haven't had that since 2009. Well, we're getting it now, and I would look for more of that in the future. So what's happened is we've gone from QE as a form of ease, which really didn't work, to helicopter money as a form of ease, which in theory should work, and the baton has been passed from Yellen to Ryan. It will not have a big impact in 2016. The amounts just aren't big enough, but this cat is out of the bag, and I would expect these deficits to get bigger as the economy gets worse. See, when we actually go into a technical recession, which I do expect, and unemployment starts to go up a little bit, which it will be a reversal, but of course, as I said earlier, that's a lagging indicator, so don't look for that to happen happen in the next couple of months, but maybe by late 2016, unemployment starts to go up again because we're in a recession. The political consensus for larger deficits is going to be pretty strong. I mean, if you're a politician, what's not to like about spending money, right? And the Fed's sitting there saying, bring it on, we'll buy the bonds if need be, but we don't want to buy them in a sterile QE exercise. We want to buy them in an honest-to-goodness debt monetization exercise where you guys, meaning the Congress, are spending money like crazy. That, in theory, should actually work. Now, you've got to spend a lot. You got to run. We're talking about going back to trillion-dollar deficits. Is there political appetite for that? Not today, not in a presidential election. I mean, Trump, Cruz, one of these guys will go burn down the Fed. But after the election, regardless of who wins, in a recession, the political winds will shift very abruptly, and there will be appetite for it. It'll be, this will be a chance for maybe, I don't know who's going to win the election, but whoever does, and certainly if it's a Republican, it's going to be their chance to do what Obama did in 2009, which is just blow a hole in the, expand the deficit. If that happens, and it is happening in small ways, but if that continues, which I expect, then that's going to be the turning point, John. Then the market's going to wake up and say, okay, you guys are serious. No more of this QE stuff. You guys are going to just spend whatever it takes, as long as it takes to get the inflation. If you're doing that, I'm buying gold because I don't want to be the last guy, on the bus. So that's how it'll play out. But patience is a virtue. I think the gold will go. Absent a geopolitical shock, which is always a possibility, absent a severe financial panic, which is always a possibility. I'm not predicting either one, but, you can't rule those out. Absent that, I would expect gold to kind of chug along, sideways, maybe up a little bit through this tightening period, mainly because it'll be a victim of the strong dollar. Eventually, even the Fed will understand that they blundered, and they'll reverse course. The Congress is already ahead of them, and then we'll finally get the inflation people have been talking about for 7 years.
Well, thanks, Jim. I just can't remember when we've concentrated so much information in one webinar. I know we've got to let you go at the top of the hour. You have an appointment, but maybe, Alex, we have time for one question from a listener for a brief response from Jim here.
Sure. This is really hard to select a question because we typically get a bunch of questions. We want to thank the audience for all the questions that get sent in. We get them on the webinar. We get them in email. We also get them over Twitter. But I want to thank Jim for addressing the last question. He did a pretty in-depth part on gold because that's the majority of the questions we're getting right now. There's a lot of questions regarding gold sentiment. Most of it is obviously Western sentiment. It doesn't necessarily mean the East and the Arabs, etc., are having the same sentiment. But in USD terms, there's a lot of concern for the gold price. So we only have a very few minutes left. I want to acknowledge that we've got a lot of international, both clients and people who are interested in what Jim has to say. So this particular question is going to be more of an international nature. And the question is, how bad will the global dollar-denominated debt problems become if we have a stronger USD over the next 6 to 12 months? And I want to add to that, if possible, what do you think is going to happen? Do you think we're going to have a stronger dollar towards the end of 2016 or a weaker?
We're going to have a stronger dollar for at least the next 6 months, maybe a little bit longer. And at that point, I don't think it will go weaker because it would go weaker if the Fed cut. But I explained how the Fed will not be able to cut for political reasons, having nothing to do with economics, because it'll be, at that point, 2 or 3 months before the election. So the earliest Fed cut would be in December, maybe not even then, but that would be the earliest. So a weaker dollar feels like a 2017 event. Just kind of answer the first part of the question. The non-U.S. dollar-denominated debt collapse is going to make this high-yield collapse we've seen the last 2 weeks look like a picnic. You're talking $9 trillion of U.S. dollar-denominated debt borrowed by emerging markets borrowers, not sovereign debt. We're not talking about sovereign debt. We're not talking about stuff that the IMF can come in and fix. We're talking about corporations, mostly corporations, or provinces or regions, and so, as the case may be. And with the global economy slowing down radically, with the dollar getting stronger, they're not going to be able to pay off that debt. And you're going to see a wave of defaults. And it's already starting, but everyone's just whistling past the graveyard on this. But we're going to see multi-trillion-dollar defaults. And the question is, to what extent do the central banks of the countries of these borrowers, and here we're talking, we know who they are. We're talking Russia, Brazil, South Africa, Indonesia, Turkey, Malaysia. It's not a mystery. We know who the countries are. To what extent are their central banks willing to exhaust their reserves to prop up their local borrowers. Because in theory, a corporation that owed dollars and was getting local currency revenue and couldn't really afford the dollars in real terms, in theory, they could go down to their local central bank and get some foreign exchange if they can't roll over their debt. But how will the central banks be willing to go? My view is not very far. Is Russia really going to exhaust their reserves to bail out, some auto distributor in Moscow? I don't think so. So those defaults are going to come in a big way. They haven't hit yet. We've seen the beginning. We see waves breaking on the beach in the energy sector. Certainly, fracking, that's already happening now. Other forms of high yield, but a lot of that high yield story is energy, but that's going to spread dramatically over the course of the next year, and we're not going to get any relief from a weak dollar until 2017. I think by then it'll be too late. The combination of weak growth and strong dollar is going to sink a lot of these borrowers.
Okay, very good. Thanks, Jim. We appreciate it.
Merry Christmas and Happy New Year, and we'll see you next time.
Thank you, Jim, and the same to you from all of us. Thank you to our listeners for spending time with us today. Let me encourage you to follow Jim on Twitter. His handle is @James G. Rickards. So goodbye for now. I hope you've enjoyed this very rich, very information-packed presentation as much as we have participating in it here. And we look forward to joining you again in 2016. Goodbye for now.
You've been listening to part 2 of the latest podcasts from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.